Is America about to collapse? We've seen some pretty wild times in the markets lately, with banks falling left and right and the Fed raising interest rates at the fastest pace ever. That leaves many people wondering if we're on the verge of the next big financial meltdown. So the question is, what do the experts see on the horizon, and how should you prepare? We'll start by looking at the warning signs that indicate whether or not we are headed for a crisis, then figure out how bad things could get. Next, we'll discuss what you can do today to protect yourself and your family. Finally, we'll answer the million-dollar question: is this something to be worried about? Or is the media just sensationalizing everything to get clicks? As always, we will provide timestamps so you can skip ahead to any section you want to watch first. Let's begin with the warning signs. And there are quite a few indicators flashing red across the US. Economy right now? First is our mounting national debt, which has nearly doubled since 2019 and reached a new record of $30 trillion last year. Some say it doesn't really matter because much of that is held domestically. However, we are still importing a lot of that money by borrowing from China, Japan, and other foreign holders. At some point, lenders may decide they've had enough of the risk and pull their investments, which could cause interest rates to rise even further and put a strain on the Treasury Department. The second sign is persistent inflation, which continues to run hot despite the Fed's best efforts to bring it down. Consumer prices have increased by nearly 8% over the past year, which is the largest increase since 1982. This means your dollar buys less and less each day, especially when you consider that wages have only risen by 5.1% during that same time period. For example, if you make $50,000 a year and prices go up by 8%, that means it now costs $54,000 worth of money to buy the exact same things you did the previous year. So you need a raise to keep up with the rising cost of living. But unfortunately, not everybody gets one. Third is rising interest rates, which are at their highest level in nearly 15 years after the Fed raised them another 0.75% in June. Higher rates make it more expensive to borrow money, which can slow economic growth and potentially lead to layoffs if companies can no longer afford to pay their bills. Fourth is declining consumer confidence, which is near its lowest level in a decade. People are feeling pessimistic about the economy and their own financial situations, which could lead to less spending and investment, which in turn could lead to lower profits for businesses and further job losses. Fifth is bank failures like Silicon Valley Bank and Signature Bank, which eroded trust in the financial system and led to tighter lending standards and higher deposit insurance. More recently, we've also seen several credit unions and regional lenders experience deposit runs and face tighter regulation. There are also concerns about commercial real estate values, which could fall if interest rates continue to rise or if work-from-home policies become the norm. In fact, Morgan Stanley believes that 40% of office buildings may be affected. So expect consolidation among property owners and fewer loans being issued in the near future. Now, before we go into what the experts are saying, if you're getting value from this video so far, please hit the like button. It helps me know what topics you want to see more of, and it helps my channel grow. Thanks for doing that. I really appreciate it. Next, let's talk about what the experts are saying. There is no shortage of opinions about the state of our economy and where it's headed. Let's take a look at a few of the most recent outlooks. First, Bloomberg reported that economists are evenly split between a soft landing and a recession in 2023, but they all agree that it will be a tough road to get there. They also admit that the Fed may have to engineer a mild recession to bring down inflation, which means job losses and wage cuts could be on the way. Second, CNBC reported that top economists fear a return to 1970s stagflation, which was a period of slow growth, high inflation, and rising unemployment. They believe that supply chain disruptions, geopolitical tensions, and tight monetary policy could lead to a similar scenario where the economy stagnates and prices soar. Third, JP Morgan believes that the U.S. economy could avoid a recession by the end of 2023 because consumer demand remains strong and the labor market is still healthy. However, they also warn that the Fed could make a policy mistake by tightening too much and causing unnecessary pain to the economy. Finally, former Treasury Secretary Lawrence Summers says that we are in an economic crisis and that inflation is likely to persist because of price increases in services and wages. He believes that the Fed will have to raise rates above 5% to get inflation under control, and that there is a 10% chance of a repeat of the 2008 crisis due to global events. So, what do all these experts agree on? Well, for starters, they all acknowledge that inflation is a serious problem that needs to be addressed. They also agree that the Fed has to raise rates to bring it down, even if it causes some short-term pain to the economy. However, they differ in their views about how much damage it will cause and how quickly it will disappear. Some are optimistic that it will be mild and temporary, while others are pessimistic that it will be severe and long-lasting. Next, let's explore how this could impact everyday Americans. The effects of a financial crisis can be devastating for ordinary people who are not prepared for them. Here are some ways it could affect you personally. First is jobs. During a recession, companies often scale back and lay off workers to save money. This could lead to higher unemployment and reduced incomes for families. Second is credit card debt. When people lose their jobs or have their incomes cut, they may turn to credit cards to pay for essentials, leading to higher balances and missed payments. Third is housing. If home prices fall and mortgage rates rise, homeowners with adjustable rate mortgages or those who bought recently at the peak may find themselves underwater or unable to sell. Fourth is the cost of living. A financial crisis can lead to higher prices for goods and services as demand falls and supply chain issues persist. This can erode your purchasing power and force you to cut back on expenses. Fifth is savings. Many people have depleted their emergency funds during the pandemic or recent market volatility, leaving them vulnerable to unexpected expenses or income loss. And finally, it's important to note that not everyone will be affected equally by a financial crisis. Low-income earners, minorities, and women are often disproportionately women and people of color who are already facing systemic barriers to economic security. A crisis can exacerbate these disparities and create a ripple effect that lasts for generations. Now let's talk about what could trigger a crisis. There are various factors that could push the economy over the edge and cause a financial crisis. Here are some of the most likely scenarios based on expert opinions. First is geopolitical tensions such as the war in Ukraine, the conflict between Israel and Palestine, or tensions with China over Taiwan. These conflicts can escalate unexpectedly and cause market volatility, commodity price shocks, and investor panic. Second is political gridlock, such as the current debate over the U.S. debt ceiling. Deadlock in Washington could undermine confidence in the government's ability to manage its finances and lead to a default, which would trigger a recession. Third is a global economic slowdown caused by rising interest rates, inflation, or geopolitical events. A weaker global economy would reduce demand for U.S. exports and depress stock prices and commodity prices. And finally, a crisis could be triggered by a tech bubble bursting, a real estate crash, or other asset price declines. A sharp drop in asset prices can erode consumer wealth, reduce spending, and trigger a negative spiral. In conclusion, it's possible that the U.S. economy could head for a financial crisis if certain events occur, but it's impossible to predict with certainty whether or will happen. Some experts are optimistic that the economy can avoid a recession through soft landing, while others are pessimistic that it will face a prolonged period of stagnation. Regardless of the outcome, it is essential to stay informed about the state of the economy and take steps to protect yourself financially. You can do several things now to prepare for potential challenges ahead. First, build an emergency fund with 3 to 6 months' worth of living expenses in case you lose your job or face unexpected costs. Second, diversify your income sources to reduce your reliance on a single paycheck. Third, reduce your debt burden, especially on credit cards, which typically have the highest interest rates. Fourth, invest in a diversified portfolio of assets such as stocks, bonds, and real estate to cushion the blow if one asset class underperforms. And fifth, stay informed about the economy and be prepared to adjust your spending and saving habits as needed. To sum it all up, is America definitely heading for a crash? No one can say for sure. Even experts have different opinions and predictions. But what we do know is that staying informed and prepared is always a good idea no matter what happens. Don't let fear or panic dictate your actions, but rather use this knowledge to make smart decisions about your finances and your future. Thank you guys for watching. If you found this video helpful, please hit the like button and leave a comment below. Do you think a financial crisis is coming? We would love to hear your thoughts. And if you haven't already, please subscribe to our channel as we cover a wide range of money and economics-related topics every week. Also, check out our next video on insert video title here. Thanks again for watching, and we'll see you in the next video.